London, May 6, 2010. In a modest, semi-detached house in Hounslow, a 31-year-old man sits in his childhood bedroom. He is wearing a tracksuit, drinking a glass of milk, and staring at 6 flickering monitors. Outside, his neighbors are mowing lawns and washing cars. It is an ordinary Thursday afternoon in suburban England. But 5,000 miles away, in Lower Manhattan, the most sophisticated financial system ever built is about to lose its mind. At 2:32 p.m. Eastern Time, the Dow Jones Industrial Average begins to fall. Not drift. Fall. In the next 36 minutes, nearly $1 trillion of value will vanish from the American stock market. Blue-chip companies will trade for a penny. Others will spike to $100,000 per share. The machines that are supposed to discover prices will start inventing them. Traders on the floor of the New York Stock Exchange will stand in silence, watching numbers that no longer mean anything. And in Hounslow, Navinder Singh Sarao keeps clicking his mouse. One more time. This is the story of how one man in a bedroom exposed the most dangerous lie in modern finance, the lie that the machines are in control. To understand what Navinder did, you have to understand where he did it. The E-mini S&P 500 futures contract. This is not some obscure corner of finance. This is the arena, the place where the biggest banks, the most aggressive hedge funds, and the fastest trading firms all stare at the same order book, trying to read the future a fraction of a second before everyone else. By 2010, this arena had become something new. It was no longer human. High-frequency trading firms had taken over. They spent hundreds of millions of dollars on fiber optic cables, co-located servers, and algorithms designed to react in microseconds. They were the apex predators of the digital jungle, turning tiny price movements into millions of dollars of profit all day, every day. Navinder Sarao was not supposed to survive in this world. He had no Wall Street infrastructure, no direct connection to the exchange. He was trading from a retail account with a standard internet connection. He had one advantage. He understood how the machines thought. And he hated them. He called them the big boys. He believed they were rigging the game, and he was determined to beat them at their own rules. For years after the flash crash, the official story sounded clean enough to survive the news cycle. A large mutual fund in Kansas had executed a massive sell order. Liquidity disappeared. The algorithms overreacted. The market broke for 36 terrifying minutes, then recovered. A technical glitch. An act of God in a machine we do not fully understand. But that story always had holes in it. If this was just one oversized order from Kansas, why did the market completely disconnect from reality? And why, in the years after the crash, did the same strange patterns keep appearing in the data? Regulators spent 4 years looking for the monster. They imagined a rogue algorithm in a glass tower. They imagined a giant institution. They imagined scale. What they were slower to imagine was something smaller and more humiliating. The weakness was not size. It was trust. The entire market was built on how machines interpreted intent. And intent can be faked. Navinder figured that out before almost anyone else. He became known for an almost supernatural feel for market structure. He could sit in that bedroom and make the order book lean in the direction he wanted. He could sense where the fast money was clustered. He could press on pressure points that billion-dollar firms did not even realize they were exposing. His weapon was a technique called spoofing, refined into something prosecutors would later call dynamic layering. He worked with a programmer to build custom software. It allowed him to place thousands of massive sell orders just above the current market price. To the high-frequency algorithm scanning the order book, it looked like a tidal wave of selling was coming. A wall of supply forming overhead. The machines reacted exactly as they were programmed to react. They backed away, they repriced, they sold their inventory before the wave could hit them. And that drove the price down. That was the trap. As the price fell, Navinder's software would instantly cancel his sell orders. They were never meant to execute. They were theater. And in the space he had created, he would buy at the new, lower price. He was the matador, and Wall Street's algorithms were the bull. By the time authorities closed in, prosecutors said he had made more than $40 million. He still lived with his parents. He drove the same ordinary car. He wore the same tracksuits every day. He once called the exchange to complain their systems were too slow for the trading he wanted to do. That detail matters. It tells you how confident he had become. He was not surviving the market. He believed he understood it better than the people who built it. Then came May 6th. Europe was deep in a sovereign debt crisis. Greece was on the edge of default. Risk appetite across global markets was already brittle. Everyone on the trading screens was pretending to be calm, but the system was dry tinder waiting for a match. When Navinder activated his layering software that morning, He did not know he was about to light a fire that would burn across the entire financial world. His spoofing orders created a massive sell pressure signal in the futures market. The high-frequency algorithms saw what looked like overwhelming supply. They did what their code told them to do: retreat, reprice, sell. But this time, there was no floor. The machines started selling to each other, a feedback loop of automated panic, accelerating faster than any human could intervene. Futures collapsed, equities followed. The contagion spread across every asset class in seconds. In New York, traders watched their screens in total silence. Shares of Procter & Gamble, one of the most stable companies in America, traded for a penny. Accenture dropped to zero. Other stocks spiked to prices that existed nowhere in reality. The machine that was supposed to discover value had started hallucinating. And in Hounslow, Navinder was not watching a news broadcast. He was inside the feedback loop. He made nearly $1 million in the time it takes to eat lunch, while the world economy teetered on the edge of something no one could name. The world would later ask, did one man cause the flash crash? That is the wrong question. The better question is this: what exactly was he showing the machines, and why did they believe it so completely? 5 years later, federal agents arrested him in London. The Hound of Hounslow was suddenly facing charges that carried a theoretical sentence of 380 years in prison. Fraud, market manipulation, wire fraud, commodities violations. The government described him as a financial terrorist who had held the global economy hostage from a suburban bedroom. The bull case for Navinder was seductive: a lone outsider, no Ivy League degree, no skyscraper office, just a man who had beaten the machines that were supposed to own the future. The bear case was darker. He was a market manipulator who had risked the retirement savings of millions of people for his own profit. The $40 million he made was money that came from somewhere. From pension funds, from ordinary investors, from people who trusted that the price on their screen meant something real. But here is the truth that neither narrative fully captures. Navinder Sarao did not break the market. He revealed that it was already broken. The flash crash happened because we built a system where perception can become reality before reality has time to answer back. The order book was supposed to show genuine intent. Under stress, it became a stage. And the fastest, most sophisticated actors in finance could still be fooled by something that only looked real for a few seconds. Navinder was later diagnosed with Asperger's syndrome. In court documents, his lawyers argued that he never really understood the human consequences of what he did. To him, the market was not a collection of human dreams and retirements. It was a video game, a game with rules he could see more clearly than anyone else. He did not want the $40 million. He never spent it. He wanted the high score. The regulators took 5 years to find him, not because he was a genius hiding in the shadows, but because admitting he existed meant admitting something they did not want to say out loud: that the entire financial system had become a fragile illusion. Today, the markets are faster than ever. We have more circuit breakers, more surveillance, more people promising the system is safer. But the fundamental architecture has not changed. Algorithms still read order flow. They still react to what looks like intent. They still amplify the signals they detect. Retail investors see a clean app and a price that looks official. They do not see how fragile trust becomes when speed replaces judgment. Navinder Sarao did not invent the weakness. He exposed it. And that means the next breakdown will not announce itself as a villain story from a suburban bedroom. It will look efficient, rational, automated, until suddenly it is not.